Welcome. This is Accounting with Bennett Tchaikovsky. Our topic today is the statement of cash flows. We're going to be going over a very basic, not basically, example. This presentation is copyright 2008 to 2018 by Bennett Tchaikovsky, all rights reserved. If you have a question about this presentation, please feel free to email me 1812cpa@gmail or bennett1812@gmail.com. Okay. So we're going to go ahead today and we're going to actually prepare a statement of cash flows. And from the prior video, the way we're going to set this up is we're going to have the company name, statement of cash flows. There will be a year ending, and we're going to start with our beginning cash, go through the various different activities, operating, investing, and financing. And we're going to get to our changing cash, ending cash balance, and then we're going to address non-cash transactions. So what goes where? When we're analyzing balance sheet accounts, because that's really what we're going to be doing, is we have operating, investing, and financing. What we're going to do is we're going to be looking at the various different balance sheet accounts, and from our analysis, what we are going to do is we're going to say, okay, what goes into which part? And so this is a listing here. It's not meant to be comprehensive, but again, it's something that you want to just kind of be aware of. So an operating bad debt expense, depreciation expense, amortization expense, stock compensation, change in accounts receivable, inventory, and prepaids, net income or net loss, change in accounts payable, accrued liabilities, and income tax payable, gain or loss on the sale of equipment. For investing activities, cash proceeds from the sale of PP&E, the purchase of property, plant, and equipment, any kind of changes with marketable, equitable securities, business acquisitions, and then here, leasing transactions. And remember, go back to the first video. What are each of these areas for, right? Financing tells me how I'm raising money for my company in particular. Did I sell common stock? Did I issue dividends? And did I repurchase or sell bonds payable? Did I repurchase or sell my own bonds? And then do I have any leasing transactions? Lastly, those non-cash transactions are going to be disclosed separately: stock for equipment, bonds for equipment, and stocks for bonds. So let's take a look at our first problem. We have Panther Inc. And I'm going to go through right now and do this for you with a little bit. It's going to take a little bit longer, but I want to show you how to go through and set up the various different accounts in terms of how do we go through and actually prepare a statement of cash flows. So the first thing we're going to go through and do for Panther Inc. is the question is going to be asking us, prepare a statement of cash flows for the year ending 12/31/20 for Panther. Help if I had the question. Good job, Tchaikovsky. All right, so this is what I'm going to go through and do, is I need to prepare a statement of cash flows for Panther Inc. This is a very basic statement of cash flows. And I want to be really, really clear about this because there's no current or non-current assets. You know, I'm doing this because you want to, I don't want to say you want to swim before you sink, but you want to start at the basic level and then work your way up. So the first thing that what has happened here with cash? Well, cash had a beginning balance of $250,000 and an ending balance of $550,000. And remember, when we are going through and preparing the statement of cash flows, what we're trying to figure out is how did our cash increase by $300,000? So here I started with 250 and I ended with 550. How did this increase happen? So let's first do the cash flow skeleton. What is the cash flow skeleton? Well, it's going to be Panther Inc. Statement of cash flows for the year ending 12/31/20. And my cash and cash equivalents, and I'm not going to fill all these out just quite yet, but my cash and cash equivalents at the beginning of the period were 250,000. My total change in cash was how much? It was 300,000. And where did I get 300,000 from? Well, my beginning cash balance right here was 250. My ending cash balance was 550. So my total increase in cash is going to be 550 minus 250, which is my beginning, equals 300,000 change. So my ending cash balance is going to be the change in cash plus my beginning cash balance. Now note here, I've gone through and I've prepared a skeleton, but I'm not going to go through and start putting things in yet. Rather, what this is going to help me with is that as I go through and I do things with the T accounts, I will then go through and prepare this. So this is just a skeleton. This is the final product that I'm going to be giving to my investor. But all I'm doing at this point is just dropping in the beginning cash balance, the change in cash, and the ending cash balance. Now, to do the statement of cash flows, what we're going to do is we're going to use T accounts. And so here, we're going to create a T account for each one of our balance sheet accounts. So I have accounts receivable, which is AR, accounts payable, which is AP, common stock at par, additional paid in capital, common stock, and then I'm going to have retained earnings. And so this larger account here is going to be my cash account. Excuse me. And when I'm doing the larger T account for the cash, I want to write out my three sections: operating, investing, and financing. And the reason why I'm doing this is we'll see this shortly. Once I go through and analyze the T accounts, this here essentially becomes my statement of cash flows, which is going to get put down here. So the T accounts are by far the most important way to go through and approach this problem. There are other ways of doing cash flows. If you want to do it the other way, stop looking at this video now or forever hold your peace. Okay. So the first thing I'm going to do, so my first step was I created the cash flow skeleton. My next step is I'm making T accounts and I'm going to enter in the beginning and ending balances, making the big T for cash. And the big T has the breakdowns in each area: operating, investing, and financing. So what I'm going to do right now, and I'm only going to do it for this video, is I'm going to put in the beginning and ending balances. For future videos, I'm going to start the question. Uh-oh, what did I do? Oh, hold on. So right here, for the future videos, what I'm going to be doing is going straight to it. Okay, so my accounts receivable had an opening balance of 100,000. Accounts receivable had an ending balance of 150. Okay, now what about cash? Well, cash, I know that it increased by 300,000, And after looking at this statement here, it should be equal to 300,000. Accounts payable is a liability account. Therefore, it has a credit balance. So 100,000, 250,000. Common stock par has a credit balance. So here my opening was 1, my ending was 1. Additional paid in capital common stock, opening is 199, ending is 199. My retained earnings had a beginning balance of 50,000, an ending balance of 250. So I have gone through the second step, which is creating the T accounts, and I'm entering in the beginning and ending balances. Notice here for the big T, I'm just kind of leaving this alone for right now, but I am showing the different sections. The next thing I want to do is I want to deal with the impact of the additional information first. So the first thing it tells me here is that Panther had $200,000 of net income for the year ended December 31st, 2020. And let's take a look here at retained earnings. So retained earnings as a T account is telling me what, essentially this is the linkage between my income statement and my balance sheet. And with retained earnings, when I'm looking at this as a T account, I can have my beginning retained earnings here, or I can have my beginning retained earnings here. And if I'm at a deficit, right, this is going to be showing up here as a debit balance. If the amount is positive, as it is here, it's going to be a credit balance. What else happens here with retained earnings? Well, if I'm going through and I'm showing if I'm paying a dividend, what happens with the dividend? I debit dividend. So here I've got a dividend. I credit cash, okay? And what happens with the dividend? Well, the dividend is a temporary account. And so that is going to be closed to retain earnings. What a dividend does is we're giving back to our shareholders. So here, dividend. And we're going to put this right over here on this side of the equation. So dividend is going to show up as a debit to retained earnings. On the right-hand side, what increases my retained earnings? It is going to be net income, right? If I'm earning funds, right, I'm going to be having net income or increasing my amount of my retained earnings. What will decrease retained earnings, or what will be a debit, will be a net loss. And when I add up all these together, I'm going to have my ending retained earnings. So call this beginning shareholders, beginning deficit. There we go. Okay, so if this was negative, not for my 1A class or my 210 class, it's going to be a positive amount. But I have a beginning retained earnings. What's going to be increasing it is my net income, decreasing my net loss or my dividend. So right here with my retained earnings, it tells me that I had net income of $200,000. So right here, I'm going to be debiting retained earnings for $200,000. And this is basically from net income. Now, what my rule is that I always do the opposite to cash. So if I'm crediting retained earnings, I want to debit cash for $200,000. So I'm going to debit cash, and this is where my net income is going to be for $200,000. So once I have put an amount here, if appropriate, I do the opposite to cash. So I'm crediting retained earnings. Therefore, I'm going to debit cash for $200,000 for the same amount. And I'm going to call it what it is, or net income. So there is no other additional information. So now what I'm going to go through and do is look at each of these accounts individually. When I look at the individual T accounts, what I am going to go through and do, let's make some colors, make it nice. Okay. So here, accounts receivable went from 100,000 to 150,000. What number do I need to balance my T account? Well, here I'm going to need 50,000. And so I need here 50,000. And what's happening here is that my accounts receivable is increasing. So I have a 50,000 here as far as being a debit to accounts receivable. For what I do to cash is I'm going to credit cash here for the 50,000. And when I come here to describe the 50,000, I'm going to say that, well, what happened? This is called an increase in accounts receivable. So my description talks about what happened to the T account, and then the number here is going to be referring back over to the opposite of what happened over here. Let's do another one. Accounts payable. Opening balance was 100,000 from the balance sheet. Ending balance was 250. So what do I need to do to balance my T account? I need a credit here for 150,000. So what do? I'm going to do the opposite to cash, or here I'm going to have a debit to cash for $150,000. And when I go through and do this, my description is going to be matching what I have over here. And with liabilities, okay, so my liabilities are going to be increased with credits. So right over here, this is going to be an increase in accounts payable. And if I'm having trouble remembering which way things go, I have my old friend who is AELOE, or assets equals liabilities plus owner's equity. Okay. DC, debit credit. What's our nation's capital where crazy things happen? It's Washington, DC. Assets are equal to liabilities plus owner's equity. Why is this important? When I have a liability account like accounts payable, I'm going to be increasing the liability because it's on the credit side. I increase my liabilities with a credit, and I decrease my liabilities with a debit because it's on the this debit is on the opposite side of where it is here. Similarly, with my assets, I'm going to be showing an increase to my assets here with a debit. If I'm decreasing an asset, I'm going to be showing it over here with a credit. The other one I'll overlay are my expenses and my revenues. If I have an expense, I'm going to go ahead and generally debit it. If I have a revenue, I generally credit the revenue. And this is why I like learning with T accounts, because it makes a lot more sense. Okay, let's go back to our problem. So here with accounts receivable, I've dealt with that. That T account is balanced. Accounts payable, that's balanced. With common stock at par and additional paid-in capital common stock, nothing happened, right? Nothing happened here, so I don't need to do anything. So I'm just going to leave these two alone. These are both balanced. Is my retained earnings balanced? And the answer is yes. So right here, I put in this net income and I'm getting to my ending balance. I want to caution you that when you are doing cash flow questions, you do not start with the balance sheet and start going through and doing these things. You have to handle the additional information first. So our magical number that we were hoping to get to when it came to the financial, or when it came to our T account here, is that I needed my total cash to show an increase of 300,000. So when I add these numbers up over here, I have here debits of 350,000. I have credits of 50. So here I have a net debit balance of 300,000. So right here, our cash is increased by 300,000. So I know that I have done this question correctly. Now, once I complete the T account here and I'm balanced, what I then want to go through and do is to prepare the statement of cash flows. And we're going to go ahead and put this up near the big cash T account because this is where it needs to go. Make it a little bit easier for us to kind of take a look at. Okay. So when I go to prepare the statement, what I'm essentially now doing is I am now going through here and inputting in the various items into the T accounts. So the first one I'm going to be using here is I'm going to have my net income. My net income was 200,000. And because I don't have a net loss, I'm just writing this here because this is where I would put it. So cash and cash equivalents beginning of the period was 250,000. So I'm going to start here with my net income, which are going to be my adjustments to reconcile net income to net loss or to net cash from operating activities. So right here, net income or the net loss to net cash from operating activities. Let's put this in brackets. We'll just kind of change this right here. We'll just put net income to net cash from operating activities. So when I go here to do my statement, if I've gone through and I've basically prepared this in this way, I'm going to have here my increase in accounts receivable. My increase in accounts receivable was 50,000. Note here, though, this is when we're doing this, and I'm glad I've stopped myself from doing this. When I'm preparing the statement of cash flows, if it has a debit, it's going to be showing up as a positive amount. Net income was a debit, so it's a positive amount. The increase in accounts receivable is a credit, so we're going to be showing this as a negative amount. So then we have over here, so this is going to be an increase in accounts receivable. I've got an increase in accounts payable since this is a debit. We're adding this right over here. So my next line here is that I'm going to add up these three different amounts. I'm adding these up and they equal 300,000. If the number is positive, what I then do is I'm going to either choose, if it's positive, I say provided by operating activities. So I've got net cash provided by operating activities, done. There was no other activity on this particular statement. And so here, because there's no financing and no investing activities. So here, once I've gone through and done this, I have my beginning cash balance, my total increase in cash, is 300,000. And so my ending cash balance is going to be my beginning plus the increase in cash, which will get me to my ending cash balance. My non-cash transactions are not applicable because there are none. So again, this is a very basic statement of cash flows question or problem, but it's very important that you know how to do this. And again, let's just take another brief overview in terms of how we solved this problem. The first thing I did is I took the balance sheet, or I should actually, the first thing I did is I prepared a cash flow skeleton, which is this. What does a statement of cash flows look like? This is what it looks like. When I'm preparing the statement, ultimately I'm going to be going through and dropping in the values that are here. But most importantly, when I'm initially preparing the statement, what I need to be able to do is to say what happened to cash. I have my beginning balance, my ending balance, cash increased by $300,000. This is the solution to the cash flow question. The next thing I went through and did is I created T accounts for all of my balance sheet accounts, doing a big T account for the cash. Then what I did is I looked at I entered in the beginning and ending balances. The next thing I did was I looked at the additional information first, and then I went through and analyzed the T accounts. Very important is that when I'm doing the T account, I do the opposite to cash, but my description is going to follow along with what happened in the T account. For example, receivables went from 100 to 150,000. So my accounts receivable increased. If I have an asset like accounts receivable, I increase them with debits, decrease them with credits. Liabilities was a credit of 150. I increase my liabilities with credits, decrease them with debits. So right here, this is showing up as a description as an increase in accounts payable. When I go to do my statement, if I have done my cash T account correctly, I'm essentially going over and translating and dropping these numbers through. So here I've got my net income, increase in accounts receivable, increase in payables. And this is going to be giving me my net cash. It's either going to be provided by or used in. And in this case, because the number is positive, it's provided by. Remember that when you are going through and inputting values into this section, if it's a debit, it's positive. If it's a credit to cash, it's going to be negative. So thank you for watching this very first introductory problem on the statement of cash flows, and I will see you on the next video. Thank you for liking and subscribing. Have a great one.